Hi, I'm Carson Block of Zer0es TV, and I'm here today with Spencer Jakab, who's an editor with the Wall Street Journal, but has recently written GameStop, The Revolution That Wasn't. Fantastic book. I just read it. Very enjoyable. And thank you so much for being here, Spencer.
Hey, thanks for having me, Carson.
So I want to start off by talking about really the title, The Revolution That Wasn't. This is a counter narrative. What was the narrative on GameStop?
So you had, and journalists are guilty of this all the time, right, Carson? So guilty is charged. We write the first draft of history, and then we look back at it after the smoke clears, and we take a more nuanced take, or we don't, or we move on. And you had literally over 1,000 stories in the English language about the whole GameStop mania as it went on in January 2021. And most of them, and certainly the headlines, portrayed it as Wall Street being given a black eye. Will things ever be the same again? Has the playing field been leveled between retail investors and big sophisticated hedge funds? And the group of people that did this, and they're not a monolith because there really were millions of people involved who pushed GameStop to be the most traded security in the world and the other meme stocks, but they really had two overlapping goals. And one was to stick it to Wall Street, to hurt Wall Street specifically above anything else. And they saw hedge funds as the sort of the cartoon villains of Wall Street. They wanted to give them a black eye, and they also wanted to make money. And really, they failed on both counts. That's the truth. And of course, there were more nuanced takes in the days after that got read a lot less. People were sick of reading about GameStop, or they already thought they knew everything about it. And that's a less exciting story. It's a less David and Goliath is an exciting story. The fact that, like, hey, retail investors are still sort of chumps, still really paying a heavy toll to Wall Street. And a lot of guys on Wall Street made a ton of money. A few lost money, obviously. Gabe Plotkin, his hedge fund, lost $7 billion in a few days. But overall, Wall Street had a great time. They had a great time in the run up to this. They had a great time during and for a few months after as well. Because when people come to Wall Street, as you know, and think that they can beat it, that's the best time for the middlemen on Wall Street who love to kind of to sucker you in to play the game.
So who specifically or which types of players in the market actually did win then?
Obviously, there will be individual people. I get a ton of hate mail from this kind of apish type saying, you don't know what you're talking about. I bought GameStop in September 2020. I made a ton of money. Of course, in any mania, there are people who bought pets.com and made a lot of money. There are people who bought .com stocks and who were, good or lucky, and almost in every case lucky, and got out and then didn't sort of return to the casino at an opportune time and made a lot of money. So individually, yes, people made money. Those stocks, by the way, the ones that I write about, GameStop, AMC, and these other things, remained elevated well above the levels that they fetched before the episode. So I guess if you were a long-term shareholder in those, and most of the long-term shareholders sold out, they were Wall Street guys who just took the money and ran wisely, then you made money. But basically, no, people lost a lot of money. People churned a lot of money. And a lot of this activity was in rapid fire trading, was in purchasing call options, which had the most bang for the buck. And I explained the reason why that was so appealing to these people and also so effective for a short amount of time in creating what's called a gamma squeeze. So individuals made money, but as a group, these retail investors did not make money. They have not made money as a group in Dogecoin and other things. And if you draw a Venn diagram, Carson, of people who are involved in this and people who are involved in these kind of more speculative, but even less speculative, more mainstream cryptocurrencies, there's a large overlap. It's people who are pretty naive, who are looking to make money quickly, who had no prior experience. I mean, it's a group of probably 80% male between the ages of 18 and 35 that were Robinhood customers that also are into trading things that kind of, it's the Dunning-Kruger effect. They have relatively little experience, and so they think they know much more than they do, and they're having some painful experiences these days.
Yeah, no, that's a really important point that you discuss in the book, the Dunning-Kruger effect, which is this notion that, what's been shown through their study that, yes, the less knowledge you have, the more confidence you have in your knowledge. And I want to highlight that because, I think we see that time and again throughout
Yeah.
markets, business, etc. So you think that was one of the underpinnings here, basically, was retail naivete. But you also make a point of talking about how during COVID, yes, you had all these retail investors you had all these people flood into Robinhood and open other retail accounts, but make the point that there were really very few sports being played professionally at that time or
Mhm.
collegiate. So therefore there was no sports betting. And you see a relationship between the void of betting and what happened in the markets at that time, right?
Absolutely. I mean, several things had to happen in conjunction for this crazy episode to happen, and so that's why I go back to really to 2018 and I trace the roots of it. And it's not only interesting to understand how this happened, how this meme stock squeeze happened, but really to understand what's going on today in the markets with retail investors and the experiences they're having, and how how all this sort of, and I hate it's pejorative, but how this dumb money came into the market and really inflated a lot of bubbles and made a lot of people wealthy, who were predatory in the market, promoters of SPACs and things like that. It's not just meme stocks. And so one thing that you had happen was that you had a lot of young men mainly playing daily fantasy sports throughout the last decade, and they had these apps on their phones. And then you had sports gambling legalized outside of Las Vegas, which mainly now it's the one type of gambling that is inversely correlated with age. You mainly have you're more likely to do it if you're young rather than old. Everything else, playing slot machines or whatever, it's older people. A lot of gambling addicts are the kind of the main contributors to the casinos, but here it was young people. And so you had sports gambling legalized in many, many states leading up to this. Then in late 2019, Robinhood, for about 5 years or 4 years at that point, had opened one out of every two brokerage accounts in the United States. And they were still a tiny broker. They had customers with very little money, but Schwab and Fidelity and E-Trade and Ameritrade couldn't take it anymore, and they all cut their commissions to zero. And psychologically, the fact that commissions were zero really kind of tripped a wire in a lot of people's minds. When something it had it cost $1 or $2, instead of $5 or $7 or whatever it cost before, that wouldn't have made such a difference. But the notion to people, and of course it's not free, but the notion that it was free to trade, I think ushered in a huge amount of activity. So you had the gambling being legalized, then you had commissions being cut to zero, then you had this kind of buy the dip mentality that was fostered by, really by the Fed and all the interventions in the market since the financial crisis, zero interest rates, and then you had the pandemic, and you had all these young people stuck at home, no sports to bet on, nothing else to do, no social life really, extra money in their pockets from stimulus checks, and extra money in their pockets from just not going to TGI Fridays on, with their friends, and having money that they normally would have spent that they were saving. They weren't paying their student loans. They might have been living with mom and dad, and I hate, just the stereotype of the 23-year-old in mom and dad's basement looking at his phone, and you've got all this social media on your phone, and you had an explosion of instant experts on social media. I mean, Dave Portnoy, who's a kind of a gambling icon to these people, was one of them, which is kind of crazy. He admitted he had traded one or two stocks in his life, and all of a sudden he had more than 1.5 million followers telling people what stocks to buy months after that, declaring that he was smarter than Warren Buffett.
I know Warren Buffett is like out of airlines. I don't want to say I'm smarter than Buffett, but clearly I am. Like Spirit Airline, bazillions of reserves. Delta, Boeing, 3 airlines that are not going anywhere. People will fly. Like, we're not getting rid of flying, all right? Like, you can get rid of fucking cruise ships. You can't get rid of flying.
And, and Warren Buffett did not look smart to these guys. Warren Buffett had sold all his airline stocks, not in a panic, but, it just looked like it was a prudent thing to do with, COVID shutting the world down. It was, in hindsight, it wasn't, but maybe at the time it made sense. And you had this 1 year period from the bottom of the COVID bear market to the year after, which encompasses this meme stock squeeze, in which 96% of American stocks rose. So it was like, like shooting fish in a barrel. It was almost impossible to pick something that didn't go up. And the things that specifically went up the most, as you know, as a short seller, were the things that were the most ridiculous. So it was a very difficult time for short sellers. And then short sellers are vilified anyway, have been historically, really as long as markets have existed. And so they became a natural target. And then when the short sellers turned out to be people who on these message boards turned out were shorting GameStop, which is a kind of, played a role in the formative years of mainly of young men. I've got 3 sons, oldest is 23. I can tell you it's a very important thing placed for them. They, everything lined up. The sun, moon, and stars lined up to create this squeeze.
Well, one of the things that you mentioned there, and that I really felt was a key point that you made in the book, when you talked about the behavioral finance really studies showing that when you drop that commission to zero, when people perceive that something is free, it's not that it's basically, a linear relationship between trading volume or, and commission drops, right, but you get this massive volume spike from people once they perceive it as free. And, it seemed to me that that's really one of the fundamental precepts here when you look at what happened in terms of creating the froth in the market and in creating that squeeze. Is that something that I'm overweighting, or do you think that that's a good assessment there?
No, it absolutely was important, Carson. And it's interesting that if you look at the commentary from the brokers themselves and the analysts covering the brokers, they finally threw in the towel in late 2019 and all went to $0 commissions. And they're like, well, it's going to cost us, but we've got to play this game. And, if you're Fidelity or Schwab, you have a pretty wealthy clientele. I think Schwab, the average account is a couple of $100,000. The median account at Robinhood at this time was $241. Okay, so completely different customer base. A customer who has a lot of money, who's older, who has planning needs, you can sell them a lot of stuff. You can give them a credit card. You can manage their things for them. You could have like a robo advisor or mutual funds or whatever. Robinhood, that was not an option. You had to get people to trade a lot. That was their whole business. They actually don't make money on some of their customers, because if you just open up a Robinhood account and trade a couple of times a year, there's no way that you're covering the overhead of maintaining that account. But you have a significant minority of their investors who trade like crazy. People who trade to the tune of more than 10,000 or 15,000 times a year. A completely unhealthy amount. The people who were worried about dropping commissions to zero failed to appreciate was that there's this thing called the zero price effect, is when you take something, not something that you just need like in life. Like if you, I think I give the example of snow shovels in the book. If snow shovels went from costing $10 to $0, you wouldn't have 10 snow shovels in your house because you don't need them, and all kinds of other things. But when certain things go from being merely cheap to free, and you like them, like listening to music or binging videos or whatever, where you kind of pay a price and then every additional video you watch is free, then people use a lot of that thing. And trading stocks, especially for this group of people who did this meme stock squeeze, who were loving it and who were having a great time playing these volatile markets, and things like triple inverse leveraged ETNs and things like that really were like lottery ticket type things, they were having a lot of fun. And so having $0 commissions, it laid the ground for an explosion in activity. You had retail turnover go from being about 10% in individual stocks, go from about 10% of the market to at the peak probably 3 to 3.5 times that during the meme stock squeeze. A big difference.
Now, where did this went initially then from, pre-COVID, you get these very, very small people coming in, and, they're not serious long-term investors. During COVID, it really became a surrogate for sportsbook or casino or some form of risk-based entertainment. Then at some point, like you said, there was this vitriol toward the man or Wall Street suits. How and when did that come to the fore, in terms of the arc of this story?
So I think that was already there. That was latent. And if you look at, I mean, it's a naive understanding of what Wall Street is, but then if you look at Occupy Wall Street, that was a naive understanding of what Wall Street is too. Because Wall Street, as you know, is mainly comprised of middlemen who just like it when you show up. It's not a lot of people risking their own money. And when they're risking money, with a hedge fund, they're really risking the money of a foundation or an endowment or wealthy people. And, they're in a sort of, they themselves are making a lot of money most of the time. It's kind of a heads I win, tails you lose type situation. It's kind of 2 and 20 fee structure a lot of the time. And so they did not understand the nature of Wall Street. They had a cartoonish version of it. And it was born out of their formative experiences. Think even if you were at the upper end age-wise of this group and you were in your early 30s, your formative financial experience was before you could ever invest money, was seeing your parents possibly struggle during the financial crisis, maybe you struggling to pay back your student loans, and blaming others for it. And I mean, there is some people should also have thought like, well, maybe I shouldn't have done this degree in sociology and taken out 200 grand in loans or whatever. I mean, let's not get into that. But I mean, there's personal responsibility, and then there's this sort of why was I allowed to take out these loans? Why are these people allowed to take out these subprime loans? Wall Street is greedy, and we never got our pound of flesh out of Wall Street. No one really went to jail. A few people kind of lower down in the food chain went to jail, but all these senior executives, Dick Fold and whatever, they lost some money, but they're still rich, and they walked away from it, and mom and dad lost their house. And so there was a real hate of, and not of rich people, by the way. So there are rich people who played a role in this story, who egged people on, Chamath, Elon Musk, and what have you, who were very rich, who actually their wealth is really owed to Wall Street, but that's not well understood. But they're not of Wall Street. They made their money due to Wall Street, but they're not of Wall Street, and so they're okay, they're cool, and they're icons. But then a hedge fund manager of the same age is absolutely not cool as someone where you're happy to see them lose money. They imagined that causing these people to lose a lot of money, and they did succeed in doing that, which is a pretty incredible story in and of itself. It's a story of hubris and finance, and how finance works, and how finance works these days. And it's more also, especially a story about how social media works these days. They were loving it. There are people who are still in this who think that there's going to be a bankrupting of Wall Street. So there's a small sort of hardcore of conspiracy thinkers who think that there will be the mother of all short squeezes, and Wall Street will be bankrupted, and they're going to be trillionaires or something. So it's like pretty naive, but that's how they see it.
One of the things that's really interesting about what you just described, and it's a phenomenon that I've noted many, many times over my short selling career, which started in 2010, is that coming out of the financial crisis, actually there was, in the media and in popular culture, there was actually a somewhat positive view of short sellers, because short sellers had identified the housing bubble. Short sellers were screaming from the mountaintops. And yes, short sellers did capitalize on it, but short sellers for a time anyway ended up being heralded as really the Cassandras of that. And I guess when you look at that vitriol that you talked about among this generation, millennials, Gen Z, who saw their parents struggling through the financial crisis, any thoughts, especially being in the media, how and when this became this inverted, and suddenly, if you hated the financial crisis, you suddenly hated short sellers.
I think that short sellers have just over history have a poor reputation, undeservedly poor reputation. I mean, betting against a stock is first of all is just as legitimate an activity as betting it will go up, and you're fighting historical trends. Stocks rise over time, so you're playing a very dangerous game where your losses are theoretically unlimited, and your maximum gain is capped. So it's the inverse of everyone else. Fighting that historical trend. Very often short sellers like go out and you expose frauds, although they don't all do that. Gabe Plotkin And that's the bulk of short selling, as you know, is people looking at relative value and relative performance and saying that, I'm going to invest in this business, but I'm going to use money from basically leverage from shorting another company in the same business. So I think that GameStop is eventually going out of business. I think Best Buy is a good company. I'm going to short GameStop and then use some of the proceeds to increase my position in Best Buy. And then, if the overall retail market sinks, then I'm cushioned, and if it all rises, then this will enhance my performance. And that's the game most of the time. And then there's a shrinking minority of people like you who are dedicated to short selling, who go out and say this is overvalued, or this is fraudulent, or this is fishy, and this business makes no sense. And I guess you had the Big Short, which was a kind of a brief shining moment for short sellers, and you had a character from the Big Short, played by Christian Bale, Michael Burry, who played a role in this.
Mm-hmm.
He liked GameStop though, so he was. I don't think people really understood that that he actually, like, his biggest claim to fame was, and it was, he did it through credit derivatives, not through short selling a stock. But there's still this perception that if you sell a stock short, you're somehow ruining the company where people work and people invest, and you're ruining people's savings, which is not the case at all, because and in fact, the run up to this was such a tough period for short sellers that, and that's the irony, is that it's bad for retail investors. If you're a legitimate long-term retail investor, but you don't know a great deal, you don't have a research team, you don't know how to pick stocks. If short sellers are chased out of the market, if they have a very hard time operating, then it's more difficult for the price to be approximately correct. Of course, the prices change every day in the stock market, but you can have an outright fraud like Enron stay in business for a lot longer time. But you can have just a simply overvalued company like Nikola, the hydrogen truck startup, stay overvalued for a really long time because it's so dangerous to sell it short, because you have these surges of enthusiastic buying from uninformed people that stampede the shorts. So times when short sellers are running away from the market are generally not an auspicious time to be a inexperienced retail investor getting into the market. So it's not that they're doing it out of any altruism. I think that exposing frauds is good and nice, but their presence enhances the market in all sorts of ways, and an environment where they can't do their job, or the rules are rewritten briefly where they can't do their job, which has happened many times. That's not good. That's bad for retail investors. The exact opposite of the kind of the common perception.
Yeah, and you point out that when the meme stock squeeze happened, and a lot of short sellers, the more traditional short sellers, basically threw in the towel on their single name shorts, that there were a lot of dislocations. This had reverberations in the form of equities that sold off. So going back to your point about how a lot of times as a long short fund, you're financing the long side of your trade by being short something that you feel is going to also hedge out the beta.
People looked at what Gabe Plotkin and other people who are in trouble and said, what are their long positions? Okay, well, they're distressed. Let's hit those things, right? Or they swooped in and bought them at a bargain. So basically, there were other funds understood exactly what was happening and acted in an opportunistic way. And speaking of acting opportunistically, you had a lot of people who were just a dumb luck, in the right place at the right time. They happened to have a position in this. You had a private equity firm called Silver Lake that was going to take a huge bath on it, these convertible loans that it had sold to AMC or for AMC, and then it converted them. It got out. It made money when it looked like it was going to lose a bunch of money. And you had a bunch of other cases. And then you had a lot of executives at these companies who got very rich, or they were already rich. So, if you don't like rich guys in suits, then I hate to break it to the kind of the people who did this, but you made a lot of rich guys in suits who were Wall Street adjacent. They were top executives of these firms, a lot richer as a result. And they didn't do anything to deserve it. Not that deserve is a word that really should come into play with highly paid corporate executives a lot of the time, but they really did not deserve it. You had the CEO of GameStop walk away with a package worth, he was the I think the fourth CEO in 5 years, package worth $139 million. The whole company, less than a year earlier, was worth $210 million. He walked away with a $139 million package. The company had not made money at any point during his tenure. Nothing that he did. He just, it just kind of was paid to walk away because you had this new group led by Ryan Cohen that came in. I mean, it's and then the poster child for this is who would not speak to me for the book is Adam Aron, who's the CEO still of AMC Theaters. He and his fellow executives, I think I might be losing track at this point, have sold something to the tune of $90 million worth of stock, while egging these young enthusiasts on who they own basically all the float of the stock that isn't owned by index funds, is owned by these retail investors who've bought big stock issues. They've raised over $1 billion in the market at really inflated prices. So it's not nice at all. I mean, in terms of the SEC, I think that's a bit of a gray area. It's hard to say what they're going to do. They're always very slow to step in. They did, and I outlined this in my book. They did step in, although pretty late, in the Hertz saga, where Hertz, I mean, they did come back in the end, but it looked like that stock was worthless. And they said, well, we become a meme stock. We're going to sell $1 billion worth of stock to these schmucks, we're buying the stock, and the SEC is very, very late to come in and protect investors, which is what, one thing that short sellers do. Short sellers are there a lot earlier than regulators.
But that's actually when I read your discussion in the book of Hertz, that really brought me back to that time. And I kind of had I think, an unpopular viewpoint at that moment in time. So Hertz had filed for bankruptcy, but then it became basically an early version of a meme stock. The market cap exploded. They said, okay, we're going to do an offering, and all this money is going to be used to repay our debt because we're bankrupt.
Right.
And there was a bid. There was still this retail bid. Nobody cared. They thought this was great, and the SEC stepped in. But here's my question. So at the time, I didn't think the SEC got it right on that one. And that was unpopular, I think, among some short sellers and, also media, because there was this view that, look, the retail investors are getting ripped off here. I mean, obviously, they're putting money into what's going to be worthless equity for them because it's just going to be given right to the money is going to be given to the creditors along with the, new equity. When you look back and you look at that meme stock squeeze, see, I feel that does to some extent validate what I was saying at the time, because I felt that you had to early on impart this market lesson, that this sort of really nihilistic, just trashing of money for fun or God knows what is, that it should hurt. And I kind of wonder if on the front end, that deal had been allowed to go through, and then there were these bag holders in a very high profile manner on the front end, whether you would have gotten such profound just distortions in these meme stocks later on.
That's an interesting way to view it. And I've been asked many times about the meme stock squeeze. Well, what's the positive that came out of it? A lot of these people lost money. Will they have these sort of formative financial lessons? Will they say like, well, okay, now I know what I don't know. Now I know that I don't know what I'm doing. I think in the case of Hertz, it was all written out there in the very clearly because they didn't want to be sued in the securities offering. What was likely to happen, that you were basically pouring money into a black hole that someone else was going to get. This was all money for the creditors, not for you. Wall Street guys are getting the money. But they didn't understand. At that point, it was not done as a fun exercise. It was done as a kind of just a greater, either by people who mostly, I think, just didn't know. They didn't understand. They saw a line going up and to the right and they bought it. And then it was done by people who vaguely at least understood that, but bought on the basis of the greater fool theory, which is not a smart strategy either, because you don't know when that's going to end. You hope that the kind of the game of musical chairs is still going to be going when you depart, but you don't know. Yeah, I guess if you lost money in the meme stock squeeze, are you going to be a kind of a judicious, careful investor? Well, I would say that they're going to fall into three groups. I think you're going to have people like that, but it's going to be a minority of people who say, like, you know what, I need to engage with Wall Street. That's really the only way to kind of build, unless I start my own business or buy houses or something, to build wealth, to build a nest egg. You can only do it through multiplication. You can't do it through addition, right? This was not that smart. And no, maybe I'll buy some index funds, which is the smartest thing to do, I think, for the vast majority of investors. Do something completely passive, low turnover. Don't be too active. Activity correlates inversely with returns, and just and do that. Slow and steady wins the race. And at least those people have accounts now. They might, had this whole episode not happened, they might not have ever gotten on the ladder with Wall Street. I think that it's only a small minority of the people, and at least from what I can see so far, who have done that. But I hope I'm wrong. Then you have people who, and really, if you let every teenager in America spend a week at a casino, right, and gave them a bunch of money to gamble with, 2 or 3% of them would become problem gamblers. That's just that's the tendency in our brains. Some people are wired to have addictive personalities, and if you gave them a bunch of scratch off cards or whatever, and so you've also created a group of people who are going to continuously blow their money, who might not have, who've been introduced to this gambling type of activity. And the line between stock speculation, know nothing stock speculation, buy the line going up to the right, or buy crypto because you heard it's a good thing, they're greedy. They're not doing it for fun. They're doing it to make money. And gambling is a very, very blurry line. It basically is gambling. And so you have a lot of people who are going to be great customers for Wall Street or crypto promoters or what have you, and they might not have been drawn into it had this episode not happened. So that's bad, And then you have people, I think, who, and this is almost as bad, are going to say Wall Street's crooked. I'm not going to have anything to do with this place. Look, it's rigged. The buy button was taken away. There's a whole conspiracy theory still surrounding this episode, that we weren't allowed to keep on buying, and Wall Street's corrupt, and the hedge funds have this whole thing rigged. And I'm not engaging with it at all. I'm going to buy crypto or not do anything. I'm just going to put my money in the bank or not save money. And that's very costly over if you're 25 years old and you have 40 years to build a nest egg and you don't do it because you think that Wall Street is crooked. That's the crazy thing about this story is, like, you have Robin Hood going out there and saying, we democratizing finance. How dare you call our customers naive? How dare you say that, they're opportunists. They're really, it's a pretty sleazy thing that they did, getting all these young people in to basically gamble. It's not illegal, but it's not nice what they did. And then they defend themselves. They kind of wrap themselves in the flag and say, this is an American opportunity. We're giving opportunity to people who never would have gotten on the ladder. But a lot of them are just going to get disgusted with the game, and they have to bring in new customers. And their most active customers, the ones who pay the bills there, are very unlikely to make money in the markets because they're just way too active to make a good long-term return. They understand that. They know that. And they've never answered questions as to what their typical customer earns relative to just a passive index fund investment.
Yeah, and I think that this is really, for me, one of the key takeaways, if not the key takeaway of your book, is that Robinhood and these other millennial Gen Z focused, free trading brokerage firms, are really, they know that they only make money when their customers churn the accounts, basically. So they know that they're pulling in that demographic and also creating the conditions in the form of the gamification to cause the churn. And one of the things that is frustrating to me, being a market participant and having seen that, and of course, reading your book, which dives into that fact and the investor psychology or the trader psychology, is that I feel like now a lot of the political and regulatory reaction to this, taking these Robinhood type punters and almost venerating them and saying, like, well, now we need to bend market regulation and our policy making around this so that they don't get hurt. And, but they're not looking at really the top of the funnel, like what's pulling them into the market, and is that the problem? And, obviously as a short seller, short sellers are under scrutiny right now, and, maybe has some relationship to that. But yeah, I guess what's your take on this, on this kind of veneration of this really gambler that's been pulled in by Robinhood and its smaller ilk?
Yeah, on the one hand, this is something, if you read John Kenneth Galbraith, he writes about manias. He identified this in many past episodes, right, where you have the real thing that's going on, which was like involved a lot of people, involved the voting public, the angry public that's just lost a lot of money, and you'll never apportion the appropriate amount of blame to them. You're always going to sort of to look for some fault in the system, or some smaller group of people who maybe also were at fault, but when politicians are doing it, they'll always turn their gaze that way. And then in this particular case, you had a moment in time when that whole reaction was on steroids, because you had just had the January 6th riots at the Capitol. This was a few weeks after, and on January 28th, when Robinhood stopped its customers from buying any more of the meme stocks, you had this outrage reaction. And it of course, if you're a conspiracy theorist, it seemed very convenient that they did that, because it did help some of the hedge funds that were exposed and were short at the time, right? But it wasn't done on their behalf. It was done because Robinhood was going to blow up. And by the way, a report just came out a few days ago highlighting how it was much worse than we knew. Robinhood not only was very close to going out of business, was hours away from going out of business, but it could have blown a hole in the broader settlement system. Its client accounts have been frozen, and all the clients of Apex Clearing. I mean, it was a really big systemic problem, like a mini Lehman type moment that almost happened, and should never have happened. Regulators really, really failed. FINRA, SEC, and others failed. But then the politicians, this was a few weeks after the Capitol riots, and they weren't going to blame a online populist movement. They're not stupid. They first of all, they got it wrong, but I think some of them deliberately got it wrong. And of course, they're going to attack the greedy Wall Streeters and the hedge funds and the system. And now the focus is on payment for order flow, which is payment for order flow, good or bad. I mean, it's just the way that trades are paid for these days. And that's come out for scrutiny. It enables this system. It enables this system of $0 trades. So I don't think that it's inherently a corrupt system. But I had Jon Stewart had a show, and I like Jon Stewart a lot. And he had a show on Apple, The Problem with Jon Stewart, where he invited a bunch of people on. Danny Moses was there, who does know about this, and he was wasn't really allowed to get in a word edgewise.
How is it legal that they can hold a larger share in shorting a stock, in betting that it will go down, larger than the actual company is worth?
You really can't do it, except market makers get an exemption to provide liquidity. That's what they're doing in order to short stocks. So you can have a situation where, for a period of time, there can be more shares short than are outstanding potentially, or over borrowing, as they say. You have to make that right over a period of time, but there are periods of time, days until trade settles, where you don't know that the borrow wasn't secured. I don't want to go into too much detail.
Right.
It's a technical thing.
Here's why you shouldn't go into too much detail.
Yeah.
I stopped listening to you a minute ago.
Fair enough.
Bunch of other people who are saying this is the problem, and kind of pointing to the way that trades are processed. It's not the problem. It's like if I had to list the problems that retail traders face on Wall Street, it's sort of like the 20th biggest problem they face. It's not even a problem. It's something that you could reform, but it wasn't the root cause of this, right? And people are pointing to that because it seems like this conniving between different firms, and it's the problem is that they were allowed to gamble. They were allowed to speculate, and these firms made a ton of money doing it, from the brokers to the middlemen that serviced them, and then the party just got out of hand. They never imagined that it would, but they almost blew up the system.
Yeah, because in that report that you were referencing, we also learned that the internalizers themselves, with the exception of Citadel, were overwhelmed, and they were saying to Robinhood, "Don't send us any more client orders. We can't handle them. Our systems are about to crash." And
Right.
yeah, I mean, that's, it's really interesting how Robinhood, as well as the internalizers who loved this model up until that moment, I mean, they really created a monster and then lost control of it.
Yeah, because who expects all these people to all open accounts in a short amount of time, use margin if they have it available? And by the way, in addition to margin, you could open an account on Robinhood and instantly trade before your cash had hit your account, which is a part of their business model. Because that kind of dumb idea that your friend told you about, and you're like, "Oh, I don't have a brokerage account," and then you can open one up and start trading right away. That's part of their business model. It kind of sucks you in, so you don't have a few days to think about it. Exacerbated this problem for them at that moment in January 2021. Yeah, it was. I mean, they just did too good of a job stoking speculation. They didn't see it getting this crazy in just a handful of stocks too, all long in a handful of stocks.
So what do you think the long-term impact of the meme stock and GameStop affair are going to have on Wall Street, and including regulation and just what do you think changes, if anything?
I don't think that too much is going to change in terms of regulation. I think you might have, I don't know if it's really necessary or desirable, but somewhat stricter rules on short selling, where more disclosure is required, which actually opens up more of these targeted short squeezes, because you have to disclose how much short, as you know, how much short activity there is in a stock, but not specifically who is short. The way that Melvin Capital got dragged into this is they also had options positions, which were public, and so that was that alerted the crowd to them being one of the ones that was very heavily short GameStop shares, and that started this whole episode. And it was all being discussed out in the open, just in a place. It was on Wall Street Bets, where these guys didn't happen to read. Now they do read it. Now I think social media is actively monitored by the vast majority of hedge funds that have something to gain or something to lose from it. I think they'll be much more efficient at sort of clipping, profits from what retail investors are doing. Because, if you have a computer program with natural language processing that can tell a real post from a bot post and can read it faster than a human, then they already were doing this to some extent, but they're doing it even more now. They're going to see what people are up to on Wall Street Bets or on TikTok, listen to the whole video really quickly before a person can listen to it, and then go out and front run you, basically. So they're making it even harder for this sort of grassroots movement to actually make money for the majority of people who are getting into it. So it's kind of I think that there's that change. Technology marches forward, and and they have much better computers than you do as an individual investor, which is why you shouldn't try to do it. I mean, I hate to say that to people. I meet friends and neighbors who telling me about how much money they made in a stock, and they actually don't have any idea how much money they've made overall in the stock market. Very often they've underperformed, over the years what they would have done just holding a basic index fund. But people like to think that they're clever, and there are a lot of clever people. That's why dentists are smart people. You have to be pretty smart to get into dental school. They're the classic sort of sad sack investor who's smart but not smart about money. And I mean, humans just are not generally wired to be professionals. And the irony there is that you, as an individual investor, if you're very very patient and long-term focused, and own a diversified portfolio of stocks that's good, you actually can outperform most people on Wall Street. Not just if you own index funds, but you don't have an investment committee to listen to. You don't have to worry about looking dumb. You don't have to, you can hold the stock through, if you have the guts to do it. But very few people have the temperament to stick it out and to really be successful as individual stock investors. And so I think most people just shouldn't try, frankly.
Spencer, are there any topics that you'd like to cover that we haven't?
Well, now, I mean, I wrote this book. I sat down to write it on the morning of January 25th, 2021. The whole episode played out in the following days. My goal was to get the book out on the anniversary of the events. I didn't imagine then. I knew that there would be painful times on Wall Street, but I didn't imagine that the meme stocks would still be a thing a year later. So that was surprising to me. But I think that it's morphed into a lot of other things. It's morphed into crypto. It's morphed into other types of assets. And so I think this is a good time to be talking about this. It's a good time to read the book and to understand. And by the way, I've studied investing history for years. I'm fascinated by it, and I learned a lot in researching this book about social psychology. There are a lot of things that I didn't understand about how effective algorithmic social media is at egging people on. I think that you always hate to say, and you usually shouldn't say, that this time is different when it comes to investing. Those are dangerous words to say because patterns repeat themselves for a reason. Human psychology is unchanged from Paleolithic times, and so we react, whether it's tulip bulbs or SPACs, we react in the same way, the same damaging way psychologically. That's the same. But social media and free trading have really changed things. They've made it much quicker, much more damaging, and potentially much more destabilizing to the financial system. So that's the message that I would leave you with, is that the things really have become a bit different. Not people, but these customers, these companies' understanding of their customer psychology. They know what buttons to push much more effectively today, and they have technology that pushes it much more effectively. And so that I think is a kind of a core message of the book.
Well, before we wrap, I do want to tell you that I got a huge charge as I was reading the book, and I saw a section titled SPAC Jesus about Chamath. And when that appeared in print in your book, I just felt like my work here is finished. I've accomplished everything I could have set out to accomplish. So thank you for the SPAC Jesus reference. But no, fantastic book, really important to understanding what's going on today. I learned a lot from it, stuff that's going to be helpful to me in terms of understanding retail psychology and trying to manage risk on the short side. And I thank you so much for sitting down with me and talking about it.
Hey, thanks for having me, Carson. It's a pleasure speaking with you.